All right, we are looking at futures rise. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, no more extensions. President Trump vows there will be no more delays in his tariff agenda come August 1st. And turmoil in metals markets. Copper whipsaws as the president announces a massive levy on imports of the commodity. In the world of tech, Apple's chief operating officer is out, and Meta's AI vision gets sharper as SpaceX's valuation soars. A lot going on in this market today.
Absolutely. From tech to health we go, because we have some M&A. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of its blockbuster cancer drug Keytruda. As you might expect, you have Verona shares absolutely flying pre-market of about 21%, but also Merck shares up slightly as well, to the tune of about 0.8%.
Investors like that deal. Also watching copper-related stocks. Freeport-McMoRan, for example, right now up a little bit more than 1% in the pre-market after President Trump announced a 50% import tariff on that metal. And we'll be watching especially any of the smaller companies that produce right here in America, Katie.
Well, on that note, President Trump now says that he will push forward with his tariff regime with no more extensions, just one day after hinting that his August 1st deadline was not firm. The president then turned his attention to two very specific industries.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
All right, let's get the state of play from Bloomberg's Washington correspondent Tyler Kendall. So no more extensions after August 1st, although people, Donald Trump says there on copper, I guess, have a year and a half to come in?
Yeah, hey, Matt, exactly. So we are waiting for potentially these sector-specific tariffs to come down the pipe. We were expecting that they were incoming, considering that this is going to be invoked under Section 232 on the grounds of national security concerns, which meant that the administration had already launched an investigation looking into copper back in February, and then pharmaceuticals, the second sector-specific tariff that President Trump said to expect. That investigation was launched back in April. Now, typically it takes 9 months to get these underway, but it is clear the administration is working on a little bit more of an expedited timeline here, and it's really only going to complicate the negotiations on the so-called reciprocal tariffs going forward, because even though these are tariffs enacted under separate provisions under the law, they are becoming really integral in the conversations, including when it comes to the European Union, for example, which President Trump said could expect a letter in the next 2 days. He said that there will be a wave of tariff letters incoming. We could expect a minimum of 7 countries to receive them this morning. And he said a second batch will be coming later in the afternoon.
All right, Tyler, appreciate the update. That is Bloomberg's Tyler Kendall giving us a lay of the land here. Let's talk specifically about copper, because the president's 50% tariff threat is already impacting the price of copper. You have one Jefferies analyst saying, quote, that the U.S. does not have nearly enough mine, smelter, or refinery capacity to be self-sufficient in copper. Let's discuss now with Joe Doe, who covers the space for us. You had Citigroup also calling this a watershed moment. What do we know so far, and what does the reaction look like?
What we know is the president has said he's going to put a 50% tariff on copper. Don't know what copper, don't know which products, don't know how high or down the supply chain they go, and that the market had a massive reaction when he made the comment. We've seen prices pull back in both the futures traded here in New York and the LME, which is typically the benchmark globally. But we did see prices spike as much as 17% yesterday. I mean, I've covered copper for over a decade. Like, I've never seen that kind of a spike in a price in a one day. So where we sit today is everybody in this market is wondering, what are the details? what are we actually going to get? Howard Lutnick, the Commerce Secretary, said, well, it's done and we're going to get this out and you'll probably see it in a Truth social post or something like that. We haven't seen anything yet. The market does want detail. There are questions around this like, is it copper cathode, which is like raw copper? Is it copper products like semifab and others? Is it pipes? Is it copper wire? I mean, copper wire is a massive, massive industry in this country because electric grids, everything, right? So everybody's wondering where the price is actually going to be on the tariff.
And when? Also, because we're going to talk to John Wobensmith later, who runs Genco, a shipping company. And I imagine he has clients calling him saying, like, can we send over some copper now, right?
Right, exactly. What we did see a few months ago when we reported that President Trump was speeding up the 232 process on copper, we saw an arb window open up. People were rushing to get copper into the United States, anticipating that the tariff would come on earlier than expected, which meant, hey, let's get this in before we have to pay a higher price. Presumably, you're going to start seeing the same thing now that we're starting to get closer to this actually happening. But I think the question is, like, how much of that, right? Because this had already been happening. The market has been expecting a tariff to come in. I think maybe the big surprise here is that number, 50%. A lot of the market was kind of waffling with maybe it's going to be 25%, maybe it's going to be 10%. They didn't know. But now we have the President of the United States actually giving a number. So we could see that affecting the actual trade flows for the near term.
All right, Joe, look forward to talking more about this with you over the next year and a half. Joe Doe covers metals for us. He's also our economic statecraft czar, so to speak. The president threatening a 200% tariff on pharmaceuticals imported into the U.S. 200%. That threat sending European pharma names into the red. For more, we're joined by Bloomberg's health reporter, Damien Garde. So, Damien, what do we know about the details of this tariff threat?
Well, very little. And in fact, despite the terror, I think, that might be incurred by that 200% number, this disclosure by the president was greeted with some relief by analysts in the pharmaceutical sector because he mentioned that this would be 1.5 years, this kind of vague deadline in the future for which companies would have to bring more manufacturing to the United States. As you might know, many major pharmaceutical companies have been kind of tripping over themselves in 2025 to announce plans to build manufacturing capacity in the U.S. for drugs that they currently import from elsewhere. And so there is, maybe reading between the lines, a notion that Trump's earlier rhetoric about imposing tariffs almost immediately on the pharmaceutical industry, because that has evolved to this kind of like nebulous distant date and this 200% number, that perhaps those companies have succeeded in coming to the White House and saying, look, we can't overnight just start making complicated injectable drugs in North Carolina that we currently make in Switzerland, but here's what we will do. And this is perhaps a sign that that has gotten through to the administration and that they've bought themselves some time, if not kind of escaped some of the crosshairs that had been on them previously.
Yeah, in some ways, there's parallels to the conversation we were just having about copper mining, that there's just not the capacity as it stands right now to have all this production in the U.S. But Damien, I actually want to get your thoughts on another story in the health space, and that is the M&A deal that we saw this morning with Merck agreeing to buy Verona for about $10 billion. We know that Merck has been shopping around, that they have that patent cliff coming up, and it seems like they've found their answer here.
It does. I think what we're seeing, as you mentioned, Merck's patent cliff is that they currently make the best-selling drug in the world in the form of Keytruda, a medicine for many, many types of cancer. It will soon lose its exclusivity, and Merck will have a roughly $30 billion, $40 billion hole to plug in its revenue. They know that there is no one, they're taking kind of a Moneyball approach, I suppose. They know there's no one product that can recreate the effects of Keytruda on their revenue, so they are looking to recreate it in the aggregate, mostly through a series of deals and through their pipeline. So that enter Verona today, which has a recently approved treatment for COPD, emphysema, and other kind of related conditions, that has peak sales estimates in the mid-single-digit billions out into the 2030s. And that is the kind of like single or double that a company like Merck needs in order to prepare itself for the loss of Keytruda's patent life.
Hey, Damien, great to get your take on this. We're going to be digging deeper and deeper, obviously, into this issue over the next few weeks and months as well. Damien Garde there covers healthcare for us here at Bloomberg. Coming up, Sam Altman and Mark Zuckerberg are poised to reunite in Sun Valley, but their fit is going to be much cooler than we're showing you in these pictures. You got to see the glasses Sam Altman is wearing, and I'm looking forward to a pendant. over Mark Zuckerberg's turtleneck sweater. Later on, don't miss a conversation with White House Council of Economic Advisors Chairman Stephen Miran. In our next hour, we'll ask him about the effect on tariffs after the big, beautiful bill was signed on the 4th of July. This is Open Interest. Let's get out of high interest. Look at what's making headlines around the world. A Rivian-backed startup that's developing smaller EVs is getting valued at $1 billion right now in a new investment from Green Oaks Capital. The company, called Also Inc., was spun out of Rivian earlier this year. Also hasn't revealed specifics, but said its tech platform will be applicable to e-bikes and microcars, as well as neighborhood EVs, whatever that is. Mobileye is reporting preliminary second quarter results that beat expectations. It also announced, though, a secondary offering by Intel. Bloomberg Intelligence says the results reflect a stabilization in global auto production, and the offering likely reflects Intel's cash needs. And tech titans are converging in Silicon Valley, Idaho, for the annual Allen and Company conference, an event where billionaires and CEOs rub shoulders and strike deals. Our own Ed Ludlow is there, and he caught up with OpenAI CEO Sam Altman, who said he's looking forward to meeting with Meta CEO Mark Zuckerberg. The pair haven't spoken since Zuckerberg poached some of OpenAI's top engineers. Ed asked Altman his thoughts on AI talent recruitment.
I think we have obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
So that's one feud that's happening right now in the tech industry, which we're going to get to. But let's get to another feud that is underway, and that is Elon Musk responding to longtime Tesla bull Dan Ives. Now, yesterday, the analyst posted recommendations for Tesla's board to consider for Musk when it comes to his divided attention, when it comes to politics and what's actually going on with the business. What did Elon Musk say? He said, "Shut up, Dan." And that, of course, is Tesla's biggest bull on the sell side. Let's discuss with Bloomberg Tech co-host Caroline Hyde. So we're highlighting this because this is having a real impact on Tesla shares, this overarching concern that we have a distracted CEO and he's just getting deeper and deeper into politics and not focusing on some of the fundamental issues that are going on at Tesla.
The issue is Elon Musk has always given very short shrift to analysts, to the shorts out there. He's not afraid to bite the hand that feeds. Dan Ives is the hand that gives it a price target of $500. Biggest bull on the street, actually saying give 25% voting control to Elon Musk. What does Elon say? Shut up. So, I mean, it's an interesting tete-a-tete, but we do see the ongoing concerns that we have a more distracted CEO. Also, a guy who's busy launching an updated Grok later tonight. So he's busy doing that. Grok getting a lot of flack today with some seemingly anti-Semitic commentary happening on the chatbot. You've also got the guy out there raising money for SpaceX. Ed Ludlow breaking the news that it's now going to be worth about $400 billion. That's the most valuable US startup out there, as it raises a little bit more money, but ultimately makes more liquidity for those who've been working there. I think that's a real signal that people are still willing to back Elon Musk and Elon Inc., even though he's busy having a feud with the President of the United States.
It's a good reminder that we've always had these conversations around Elon Musk. He's always been in charge of several different companies at one time, and the SpaceX share sale is a great example.
Yeah, I mean, Kathy Wood was on, I think, surveillance yesterday saying that she's not worried about Elon Musk being distracted, but he has got a lot to do. I'm waiting to see what Mark Zuckerberg wears to Allen & Co. Like those glasses, right? Those Varnays that Sam Altman was rocking are truly, I mean, Mike Judge needs to come back and make another Silicon Valley with these characters. They're just amazing.
And where are the cameras and where is the AI infused into your Varney glasses? I thought actually Sam
Altman... Oh, the Meta investment, right? Another $3.5 billion into Luxor.
Luxottica?
Yeah.
Yeah, they're taking now a 3% stake in the maker of Ray-Bans and Oakleys, who make their smart glasses. They could ultimately take about a 5% stake, according to people familiar. This is them betting big on ultimately the share price improvement in a company that they've anointed to build their technology of the future. Interestingly, I thought Sam Altman was on fighting form today, and well, yesterday when he arrived at Sun Valley, also saying that, look, watch this space for our hardwares. That was the last question that was thrown at him. And they were like, what about your hardware with Johnny Ives? And he was like, it's going to be great. But at the moment, he's wearing Varnays. But he's certainly not wearing Meta glasses. I'm pretty sure Zuck will be.
Yeah, and I thought that Meta investment was really interesting because you also saw Warby Parker shares rise yesterday. Warby Parker, of course, wasn't the target of the investment, but maybe some speculation that we're going to see more of these matchups in the future.
And you've already seen it. Alphabet, Google's been getting closer to Caring Group with its glasses. We're likely to start to see more and more companies come out with this new way in which we interact with AI. It's not going to be augmented reality. That's a step too far. The Vision Pro ultimately was too pricey and not the form factor we need. But we do want to have AI in our intermediate lifestyle, and that's going to be with the sunglasses, it feels like.
We should remember, so far, Meta has invested in EssilorLuxottica, and they own both Ray-Ban and Oakley's. And those are the two brands that have been infused with this technology, right? Varney is actually owned by LVMH, so it's a completely different
fashion.
Well, owner, right? So Meta is only making glasses with the brands that are owned by Luxottica.
Yeah.
It's not like they're going to branch out and do something with a different brand that's not owned by Luxottica.
What are we trying to signal as to who OpenAI is getting into bed with? We know that they've got this partnership with Johnny Ive. We know that they've got some legal ramifications with that. And so we'll see who they particularly work with.
I'm so fascinated to see what Johnny Ive and Sam Altman come up with, because the thing about Apple is they really don't need. I know Dan Ives was out with a note today saying they have to make an acquisition, and he's saying perplexity is it. But as long as they own the hardware with which we use AI, it's okay. But if Johnny Ive and Sam Altman come up with something that makes you no longer need an iPhone, then Apple has a real problem.
But then also look at the changes that are currently happening at Apple. We've just had the yet further scoop that the COO, Jeff Williams, who'd been there running the COO role for at least a decade, saying goodbye. At one point we thought he might take over from Tim Cook. They're basically the same age. But the guy who comes in instead, Sabi Khan, he's been there for 30 years. These are people who know the business well. We're likely to see the hardware engineering guy get anointed potentially to take over Tim Cook. That's what people have generally thought. But this is a shuffling of the deck. The people in charge of supply chain here are all being regalvanized. And look, you have the latest tweet out, comment out of Peter Navarro, who's there very much trying to dictate where trade deals go, saying, Apple thinks it's too big to tariff. That's a headache for Apple right now. Is that the distraction for that company rather than innovating in AI? You've got Tesla CEO distracted with politics, and you've got Apple distracted being forced to think about politics.
All right, Caroline Hyde co-anchors the Bloomberg Tech Show. You can catch her with Ed Ludlow at 11. He'll be like lurking in the bushes somewhere at Allen & Co. Talking with a billionaire CEO, but I'm sure present on the program. Coming up on this one, we've got a wave of share sale announcements overnight, including, this isn't one, but interest in the Chinese business of Starbucks and other potential companies on the block. Details ahead right here on Open Interest.
Welcome back to Open Interest. A check on the setup when it comes to the futures market ahead of the opening bell, just about 7 minutes away. You can see we're up slightly. We had pretty much an unchanged finish for the S&P 500 yesterday with some big intraday volatility. Right now, as it stands, we're about 0.3% higher. Same story if you take a look at the NASDAQ 100. Your big tech names that live there also up slightly. Small guys are winning today. The Russell 2000 up about 0.4%. Probably helps that you have bond markets cooperating a little bit this morning. The 10-year Treasury yield down slightly below 440. Matt Miller.
All right, so overnight we saw a wave of stake sales, share sales, takeover interest from companies like Bank America and Starbucks. Those are the sellers in this. Let's get details from Bloomberg's cross-asset reporter, Isabel Lee. And I should say potential sellers, right? These aren't done deals. There's a lot of speculation here, but I want to start with AES, an energy company with an enterprise value of $40 billion.
It does have that enterprise value, and its market cap is only around $8 billion. So it's a power firm, AES, and it's exploring options including a potential sale. That's according to people familiar with the matter, and you see shares edging higher, but just around 2%. So AES provides power, renewable power, to tech companies like Microsoft, Google, Amazon, and investors including Brookfield and BlackRock have really been studying their shares after they lost half of their value in the past 2 years, of course, due to Trump's anti-renewal policy. So AES, again, to your point, has an enterprise value of $40 billion, which will make it one of the largest leverage buyouts that would rank of all time.
And you can see shares just flying right now, up about 17%. I just want to talk about Starbucks and what's going on with the China unit, reportedly drawing interest for a potential controlling stake here.
Yes, you and I like Starbucks, so shares are also edging higher by nearly 3%. So China is the second biggest market of Starbucks, and Bloomberg reported in May that it is exploring potential review of its company. So now Starbucks is in the process of reviewing those and really shortlisting candidates for a next round of bidding. And this isn't really Starbucks' preferred option. I think that's important to note because they preferred a minority stake that will help them grow their business. But now here we are. And Starbucks really has been struggling in China, and they've tried to cater to local tastes. So they've slashed tea prices. They've made 0 options for coffee. We'll see if it's working. But really, they've tried to attract more consumers there.
0 options for coffee?
No, 0 sweeteners for coffee.
Ah, okay.
Maybe I said it wrong. Did I say it wrong or you heard it wrong?
No, 0 sweet. I guess
it was matched
like
back.
no sugar options.
No sugar options.
Bank America, Kuwait.
So
Have they lost faith?
Yeah.
No.
That's too strong of
In
a
30
statement.
seconds.
Okay, so it's a $1 trillion sovereign wealth fund, and they sold a $3.1 billion stake, according to people familiar with the matter again. So the sale was handled by Goldman Sachs, and they saw it's 1.5% discount to Monday's closing price. I think the most important thing here, it follows Warren Buffett's Berkshire Hathaway's retreat. So Warren Buffett was seen as a white knight, and now they sold out. And we have Kuwait Investment Authority also doing the same, and their backing goes as far as 2008. So that's really
all right. Great roundup, Isabel. That is Bloomberg's Isabel Lee. Stick with us. The opening bell is up next. We'll walk you through the action with Seema Shah. This is Bloomberg.
We are just seconds away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at futures that are pointing higher after kind of a flattish close yesterday. 62.94 on the futures. On the cash trade, we're still about 50 points away from the all-time closing high that we hit on last Thursday. NASDAQ futures up a little bit more. Russell, the small caps, up more than 0.5% right now. You hear the opening bells. On the New York Stock Exchange, you've got Arlo ringing the opening bells, and apparently they make security cameras and the like. I should know because the stock is up 542% over the past 5 years. They've been absolutely crushing it, and that's why they deserve to ring the opening bell at the New York Stock Exchange. Meanwhile, down at the NASDAQ, Avidity is a biosciences company, and their stock is up 7% over the past 5 years, so it's better than a loss, but I think they could do better.
Yeah.
I think they could do better.
All right, so if you're listening, Avidity, Matt Miller has some opinions here. Let's stay on health, though, because we have some M&A in the sector. Merck buying UK biotech firm Verona in a $10 billion deal. Merck, as we know, is working to offset losses from that 2028 patent expiration of Keytruda, and that has really been a big overhang for the stock. You can see Merck is actually up a little bit right now, Matt Miller, about 1.6%. Verona obviously is flying, but Merck down about 33% over the past year, which is a big loss.
It is a big loss, but it looks like investors are behind this acquisition. Today, we're also watching copper-related stocks. Obviously, after President Trump says the tariff could go up 50%, customers are going to rush to bring in copper now. You can see Freeport-McMoRan, the first name that comes to mind, up about 0.8%, so a gainer there. The smaller, I'm looking at Ivanhoe Electric, for example, which makes copper right here in the United States. It's a small company, just about $1 billion, but it was up 5% yesterday, another 3% today. Equity volatility in general is poised to pick up in coming months. Goldman Sachs strategist led by Christian Müller-Glissman right, that, quote, a deterioration in tariff discussions remains a key risk, but fiscal concerns in the U.S. or U.K., potential French elections, and geopolitical tensions could also drive more volatility. Let's bring in Principal Asset Management Chief Global Strategist Seema Shah And obviously, I don't care about the UK or France, Seema. Don't even know where they are. But the U.S. markets could see more volatility as these tariffs continue to be dragged out, right? August 1st is now the deadline, no longer July 9th. And the president says copper tariffs could come in a year and a half.
Yeah, and I don't think that even the 1st of August is going to be the end of the story. I mean, ultimately, if you look back through history, trade deals take a long time to take place. Even whatever is announced on August the 1st, there's still going to be a long way after that. So in that period, there's always going to be the potential for resumption of hostilities, and it's going to continue to be a negotiating tool. So from our perspective, tariff noise, that's something which becomes a permanent feature of the economic backdrop. It's really whether or not the market's going to continue to take notice of it. But certainly in the next month or so, given where equities are sitting today, there is some vulnerability in that near term.
Is there, though? Let's talk about that a little bit more, because you get these headlines out from, of course, President Trump, especially in yesterday's cabinet meeting. It just felt like a grab bag of different industries that were being targeted, from pharma to copper, et cetera. And it just feels like there's not too much reaction, at least in the overall benchmarks anymore, like there might have been a couple of months ago even.
Yeah, that's absolutely right. And I think one of the things is, to your point, is the way that it was always almost announced was a bit off the cuff. There's absolutely no details either. So I think the market is also looking at that. But at the same time, I think one of the factors that I think markets are considering is that when you're thinking about copper, 50% tariff could be fairly negative for the US economy. So is President Trump genuinely going to go ahead with that kind of number? I think it's fair that the market is questioning it and saying, well, look, in the past, every time that there's been a really meaningful threat to the economy, he has taken a step back. So potentially this is a negotiating tool.
I kid, Seema, about not knowing where France is. Obviously, I've lived in Europe for many years. And those benchmark indexes have really crushed it compared to the S&P, right, which is up, 6% year to date. We're looking at, on the CAC 40, a 20% gain. On the DAX in Frankfurt, a 40% gain in, if you're a dollar investor. How much legs do you think those European index rallies have? Or do you see a reversal here? Is the U.S. now going to play catch up and you can sell some European stocks and put those profits into America?
Well, look, I think in the near term, as I said, I think there is some vulnerability for the U.S. given that there's so much headline risk in the next month or two. But if you're looking beyond that, I think Europe is maybe getting to the end of this current rally, starts to lose some steam. That doesn't mean it's going to be reversed. But I think you're getting to the point where investors are looking at the fundamentals, they're looking at the earnings expectations, and they're saying that there's a bit of a mismatch. And we know, of course, a lot of it is driven by these hopes around what fiscal stimulus can do for the European economy. But we do know also that typically and historically, Europe has been a bit of a disappointment when it actually comes to implementation. So we're getting to that point where European investors are saying, look, show us the money, show us actually what is going to come through, when is it going to come through, and how is it going to be spent? And then, of course, there's a potential for a further run-up. But I do think at this point in time, you're going to see a loss in steam.
Well, we should probably get some more clarity when it comes to at least the corporate picture in the next couple of weeks. Earnings season is fast approaching. The big banks kicking us off next week. And bringing back the conversation on tariffs, there was a really interesting note from Deutsche Bank yesterday, basically estimating that there could be a 2 percentage point hit to S&P 500 earnings amid all of this tariff noise that we were just speaking about. When you run your own models over there at Principal Asset Management, do you end up with something similar?
So look, we do think the S&P 500, a lot of companies are definitely exposed. I think the key question for us at the moment, though, is when does that hit come? It's not entirely clear that it is even on the doorstep, given that there's been so much front loading of imports in the last couple of months. And even from the Fed's perspective, this is really going to be key, is when do we actually see that data materializing? When do you see an increase in prices? And at the same time, we also don't know exactly how much companies are going to be able to pass on the price increases. So I do think that as the earnings season gets started next week, it's going to be really interesting to read through that forward guidance and hear some of the narrative that these CEOs are talking about and how they're seeing any implication from adjusting supply chains.
We're looking at NVIDIA. I just want to point out to viewers here, Seema, NVIDIA shares continue to march higher. It is the biggest point gainer on the S&P 500, and it's about to hit $4 trillion in market cap. Is this, continued march higher just inevitable, Seema? It doesn't seem like there have been really any big competitors able to unseat NVIDIA, even as, you know, the Chinese continue to try and have to eventually come close, right?
Yeah, I don't talk about single stocks, but I can talk about just generally the technology sector, obviously driven by NVIDIA here, is that has been a discussion point which continues to drive markets. You know, it lost a bit of pace earlier in the year because of the emergence of DeepSeek, but people are really continuing to buy into that general thesis, that kind of long-term narrative that AI is going to be the key driver of all productivity growth. We haven't seen that disappear. And interestingly, technology is actually the sector which is most exposed to tariffs because it has majority of its revenue outside of the US, and yet it's continued to outperform. So I think this gives us an idea that investors are looking through a lot of the tariff noise, and they want to see that narrative continue. So tech earnings next week, as the coming weeks go, is going to be absolutely imperative in order to make sure that beyond the next month or so, you do see these continued gains in US equities.
Absolutely. It feels like the stakes just get higher when it comes to tech earnings. Seema, great to have some time with you. That is Principal Asset Management Chief Global Strategist, Seema Shah. Let's get a check on some of these movers and the makeup of this market right now. You can see the S&P 500, it's in the green, and a lot of that comes back into NVIDIA. As Matt was just mentioning, we are closing in on $4 trillion for market cap. NVIDIA is your biggest points contributor to the S&P 500 right now, up about 2.2%. And that, of course, is fueling this entire market, though you do have the likes of Microsoft, Amazon, some of these other tech names certainly helping as well. You can see the S&P 500 up by about 0.6%. Let's take a look at the downside. There are more winners versus losers right now, but to the downside, you do have United Health Group down about 1.6%, Palantir, Apple, as we've been discussing, those woes continuing, and you can see that reflected in the single stock stories. But let's take a look at the sectors as well and see the makeup there. More green than red. Up at the top, you do have tech. Thank you, NVIDIA. Consumer discretionary as well. At the bottom, what's not doing too hot today, utilities, consumer staples, and energy, but small moves overall, Matt Miller.
Yeah, still so much news in this market that you can't take your eyes off it. Coming up, SpaceX is raising money and selling shares at a nearly $500 billion valuation, according to sources that have talked to us here at Bloomberg. We'll discuss that with the reporter who broke the story next. And in the next hour, we speak with Goldman Sachs Chief U.S. Equity Strategist David Kostin. He'll join us right before we get a chance to speak with the White House Council of Economic Advisors Chairman Stephen Miran. So a ton of news today and a ton of amazing guests that you don't want to miss. Keep it dialed in right here on Bloomberg Television.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wynn Resorts getting a downgrade over at Citi. The analyst says that he sees Wynn giving up gaming market share in Macau in the near term. Shares down slightly. Next up, we have T-Mobile getting a cut to a sell over at KeyBank. The analyst over there saying that the stock's underperformance will continue and that its premium valuation is still too high. And finally, we have Microsoft getting upgraded to a buy over at Oppenheimer thanks to AI upside. The analyst says that investors should embrace Microsoft as one of the long-term AI winners in software, Matt, and shares are up about 1.4%.
All right, let's talk about those people who are investing in this technology. Executives have descended on the Allen and Company conference in Sun Valley, Idaho. They include OpenAI CEO Sam Altman. He spoke with a gaggle of reporters about explosive growth in AI and tech.
I am a believer in technology and science and economic growth, and I think that I'm all for offering great services, and I'm all for figuring out ways to make capitalism super inclusive. But I think part of the thing has got to be we drive the country towards very significant economic growth.
The more I see those glasses, the more I want my own pair. Altman spoke after a Bloomberg scoop that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at $400 billion. That would make it the most valuable startup in the world. Bloomberg Tech co-host Ed Ludlow broke that story. He joins us now from Sun Valley. So first, on the SpaceX sale, give us the details, Ed.
Sure. Yeah, it's a mechanism that they've used historically, which is like concurrently a very small primary, selling a small amount of fresh equity to set price and therefore valuation. But the main thing is the tender, secondary, right? Give employees liquidity, allow early investors to have some liquidity as well. And it's a big moment. There's been a lot of tension between Elon Musk and the president. SpaceX has great regulatory exposure as well as a lot of business exposure to the United States government and various defense apparatus. But it shows continued growth, both on the launch business and on Starlink as well.
I do just want to quickly mention NVIDIA. We were talking about it last block. Its rise continues, and it actually now becomes the first company to reach $4 trillion in market cap. So NVIDIA ascendant this morning, and really for the past couple of years, we'll continue to keep an eye on that. But when it comes to SpaceX, part of this rise in valuation, Ed, comes back to Starlink. So talk to us a little bit about what the state of play is there, because that has also come under scrutiny.
Yeah, I mean, over time, the proportion has shifted, right? Starlink becomes more than 50% of revenue. It's higher margin business. You know, the business of sending rockets into orbit, regardless of the payload, is never going to be a big cash cow. And SpaceX increasingly facing competition, Project Kuiper from Amazon, but that's where there's a lot of hope. You know, SpaceX, like many of Elon Musk's companies, it's so hard to get into. You have the biggest private growth equity names, largest venture capital firms, other technology companies, Elon Musk's close confidants and friends, other sovereigns. But the hope is that in the longer term, the Starlink bit will be spun off. There'll be either some kind of listing or opportunity for a broader investor base to participate. And that's part of the story here around the valuation too.
Ed, I can't look away from NVIDIA here. I mean, more than $4 trillion in market cap. I will never forget when you were on air and Apple crossed the $3 trillion mark. I have that phrase ringing in my ears all the time when I think about this climb in the value of artificial intelligence companies. And in a sense, they've left Apple in the dust, right? I know we use Apple devices for the OpenAI app, but Apple hasn't made any moves, really any big moves here. Dan Ives was out with a note this morning saying they should buy Perplexity. What's your thought?
I saw that. Yeah, I mean, what's so astonishing is that Jensen Huang's not here, right, in Sun Valley, but all of his biggest customers are Andy Jassy of AWS, Sam Altman, Satya Nadella, not just a customer, but obviously an investor and partner. And what they all have in common is that they've made continued commitments to not just big picture expand data center capacity, but NVIDIA has this commitment to bring out a new generation of GPU annually. And so you have two things happening, a broader expansion of capacity where NVIDIA holds a monopoly more than 70% of the market, but also a refresh, a technology cycle that's gone from being multi-year to annual, which is astonishing. And people rely on that technology as a bedrock of what's happening. On the Perplexity thing, it's not a deal that I've been hearing about here at Sun Valley, but it's been talked about for a little while. We had Perplexity's chief business officer on the show last week, I believe, and we asked him point blank, and he wouldn't comment, but said, he wouldn't be doing his job if he wasn't talking to everyone. The ecosystem on the operating system side is really changing, but NVIDIA $4 trillion. Yeah, cool moment. It's weird not to be in the studio for it. But you guys did it. Congrats.
You're in front of a mountain, which is also pretty good. NVIDIA shares up about 2.5% right now, eclipsing $4 trillion. And we had Ed Ludlow right here with us. You can catch more of Bloomberg Tech co-host Ed Ludlow at 11 a.m. Wall Street time right here on Bloomberg TV. And we didn't even get to this meeting that could be happening between Sam Altman and Mark Zuckerberg. I know we talked a little bit about it, but not enough. We've been having so much fun with this story.
Yeah, I mean, it will be interesting. unlikely in front of cameras, right? So we're not going to see that meeting.
No.
And also, who knows if they're going to talk to each other in an amicable way?
That's
Are they
true.
going to be angry with each other?
Fisticuffs, perhaps?
I doubt that is going to
I
happen.
don't think so either. It would be nice if we could get an official readout like they were presidents of a country, but we'll continue to follow that story. And up next, we're going to talk about airplanes because Boeing hits an 18-month high for jet deliveries. More on Boeing shares and the other airlines, or rather the airlines in general, next. This is Open Interest. Well, U.S. plane maker Boeing delivered 70 aircrafts in June, and that is the most in 18 months thanks to renewed U.S. jet exports to China. For more analysis on Boeing and the overall airline sector ahead of earnings, we're joined by Syth. She is Managing Director for Airlines over at Raymond James. It's great to have you with us. Let's start with Boeing because there's obviously a lot underway when it comes to Boeing and their turnaround efforts, but there's also an element of trade policy here, and it seems like for now, those winds are blowing in Boeing's favor.
Thanks for having me, Katie. You're exactly right. It's it's great to see Boeing kind of turning around things and really showing improvement here in 2025. There is a lot of kind of uncertainty around the tariffs, and where components are made, and hopefully we'll kind of stick to the policy that was there before, which is that kind of global aviation supply is kind of tariff-free. But from an airline perspective, what we've been hearing is kind of Boeing has been delivering on time relative to new schedules and sometimes even faster, which is encouraging after several years of delays and mishaps. So, overall, a good setup here.
If, the airlines that you cover, Savi, for example, Delta, which announces earnings tomorrow, they use Boeing. They're never going to switch over to Airbus, or have they been doing that?
Thanks. But if you look at Delta, they fly both operate both Boeing and Airbus aircraft. So the largest carriers, American, Delta, and United, they fly both types. Southwest is another big carrier in the U.S. They're solely Boeing. So it's in their interest to kind of see a successful Boeing, but also have a kind of a tariff-free environment overall.
And focusing more specifically, of course, on the airlines, we got Delta kicking us off tomorrow. It just feels like demand hasn't been there. It hasn't returned to really robust levels. Occasionally, we get these bursts of optimism and you see shares pop, and then we go right back to this sort of sideways chop that we've had for the past couple of years. Are you expecting something different here, or maybe more of the same?
Right now, we're seeing just more of the same, unfortunately, Katie, because, if you look at, you're quite right. You're seeing some, green shoots that maybe we'll see demand at least progressing closer to where it was at the end of last year or early this year. But then some headlines will hit and you'll see a reversal again. What we'd be looking for, at least post-summer is there a change in corporate travel behavior? If we have more clarity around government spending, how stimulus is working, how tariffs end up, is there more comfort or certainty in for some of that corporate travel to come back? So that's what we'll be looking for. But right now, there's no change that we can discern.
All right, Savi, great having you on the program. Thanks for joining us. Savi Syth there of Raymond James talking to us about airlines after Boeing deliveries came out, and tomorrow we get earnings from Delta. Now, NVIDIA is really in our focus. It is the first ever $4 trillion company. You're here for an historic moment as the company crosses over that $4 trillion mark. It is, of course, the most valuable company in the entire world, and we're going to continue to focus on it. Coming up in the next hour, Goldman Sachs Chief U.S. Equities Strategist joins us, David Kostin, as well as White House Council of Economic Advisors Chair Stephen Miran. We are 30 minutes into the trading day. You can see markets are up across the board with the S&P 500 at 62.65. This is Open Interest. I'm Matt Miller.
And I'm Sonali Basak. We have a lot going on in this show. And of course, we're going to hear from Wall Street. We're going to hear from the administration. We're going to make sense of it all for you.
Yeah, there's an absolute ton of news. So many single stock stories and so many stories in your wheelhouse about hedge funds and private equity. So
deals.
Yes.
Anyways, coming up, President Trump escalates his trade rhetoric and threatens more tariffs on copper and pharmaceuticals.
From Merck's $10 billion bid to Meta's bet on AI glasses, that's $3.5 billion. We've got a roundup of today's big deals.
And pledging loyalty. Goldman Sachs plans to ask junior bankers to confirm every 3 months that they have not accepted jobs elsewhere.
We begin, though, with trade tensions. President Trump now says he will push forward with his tariff regime, and there will be no more extensions, just one day after hinting that his August 1st deadline wasn't so firm. The president turns his attention then to two very specific industries.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
Let's get the state of play from Bloomberg's Washington correspondent Tyler Kendall. So, Tyler, on the one hand, it looks like the August 1st deadline will be fairly firm for countries, and then the industry-specific tariffs or product-specific tariffs will be less so.
Yeah. Hey, Matt. And it's interesting because these two different tariffs, they are enacted under different provisions, but they've really become intertwined in the negotiations that we're seeing moving forward here when it does come to these expected tariff letters that could be coming more later today. President Trump had previewed that there could be 2 waves of letters today, with a minimum of 7 countries receiving them this morning, and then a second batch coming in the afternoon, as he doubles down that this really is the last chance for these countries to negotiate. The president had told reporters yesterday that we could expect some of these levies to reach up to 60 or 70%. He didn't give specifics beyond that, but of course that would be significantly higher than some of the marginal differences that we've seen so far outlined in these letters compared to the April 2nd rates. Interesting enough, he told us that one of the trading partners to look out for a letter here is the European Union. And that brings us back to the top of the discussion about the sector-specific tariffs, because it's our understanding that they are nearing a technical agreement in principle, but that the European Union is trying to find those exemptions and carve-outs when it comes to sector-specific tariffs, like autos, for example. But as this threat really does ramp up about the future of copper and pharmaceutical tariffs, that's just going to complicate the negotiations further as our trading partners rush to get a deal done by that August 1st deadline.
Tyler, we thank you so very much for keeping an eye on all of it for us. That is Bloomberg's Tyler Kendall. We're now going to bring in David Kostin. He's Goldman Sachs' chief U.S. equity strategist on the latest price target increase for the S&P 500. Because, of course, David, really interesting here. This is by far not the first time you've done this year. At what point do tariffs become problematic for you?
Well, the idea of tariffs are baked into our forecast right now. We're looking for earnings growth this year of around 7% and earnings growth in 2026 also of around 7%. And investors are now starting to turn their attention into next year's earnings. I know we're only early part of July of 2025, but the investment analysis looks into next year and discounts that back. So the idea of tariffs, we're assuming somewhere in the mid-teens, likely to be the final level. The effective rate for tariffs last year, as you know, was around 3%. It's already up into low double digits right now, but the real insight will probably be later this year when we'll have sort of a run rate level of tariffs. But from our perspective, the market investors are sort of thinking about the mid-level of mid-teens, and that's probably what's going to support an earnings growth of 7%, and that's why the market moves higher.
Companies seem to have, Nir Kesar wrote for us at Bloomberg Opinion, really fat margins right now, so they can absorb to some extent these tariffs.
I want to think about the following way. In the last 30 years, margins have gone from 5% to 12%. That's net margins for the S&P 500, 5 to 12. What are the driving factors of that? What are the building blocks? Lower cost of goods sold, lower COGS, about 5 percentage points of that improvement in margins comes from there. Lower tax rates, another reason. Lower interest expense. Those are the reasons why margins have moved higher. And so we look out in the next couple of years, tariffs are a way of increase in the cost of goods sold. That's a downward pressure, likely to be a downward pressure on margins. Some of the debt that's rolling over for some companies is actually rolling over to higher level. And so, Matt, the way you want to think about this is the tariffs are a downward pressure, and then who is going to pay for those tariffs? Is that going to be the supplier? Is that going to be the consumer? Who's going to pay for that?
All right, David, you stick with us here. I want to now bring in our Bloomberg TV and radio audiences worldwide. We're going to simulcast this. Joining us now is White House Council of Economic Advisors Chairman Stephen Miran. Stephen, thanks very much for joining us. We were just listening to David Kostin of Goldman Sachs giving an optimistic view of the stock market and the way companies are dealing with tariffs. And I wonder how you think about the uncertainty that this creates. You definitely must have calculated that in coming up with this strategy. And if we're going to see an end to that uncertainty come August 1st.
Good morning. Thanks for having me. Look, I do see the uncertainty starting to reduce in the near term. Part of the benefit of uncertainty is it gives us leverage in negotiations, right? Like the president knows how to extract concessions from our trading partners, and he has been very successfully doing so. Now, as what you've seen with a number of these letters is there's some countries that haven't made the concessions that the United States requires, and as a result of the decades of accumulated trade deficits, the president has decided that tariff rates should ratchet back up for those countries on effective August 1st, and I expect that to happen.
I want to talk more about the sectoral tariffs, the Section 232. You look at copper just over the last 24 hours and the price increase you've seen in copper alone. This is a critical input for data centers, for power grids, for industrial machinery. And as the administration looks to bring more manufacturing onshore, how isn't it the case that a 50% tariff would impact some of those other efforts to otherwise power the economy?
So you have to differentiate between changes in relative prices and changes in the general price level. And when you target a specific good with a tariff like copper or some other specific good, you're going to get relative price changes, and that's totally expected. But that doesn't mean that there's an increase in the general price level, by which we mean inflation, because there are lots of thousands of products and services that go into the general price level, and it's an average, a weighted average across all of those. And we just published research yesterday showing that there has been no tariff-induced inflation in a general price level since the tariffs began being implemented in January. Quite to the contrary of all of the Cassandras that were shouting that it was going to be extremely inflationary. There's just no evidence of that thus far. Just
Stephen,
like in 2018, 2019. Yeah.
Listen, I read the research, and we'll get back to it, but on copper, I want to read this note from Jefferies. They say that the U.S. does not have nearly enough mine smelter refinery capacity to be self-sufficient in copper. So then why target it?
Well, we need more of it. We need more of it produced domestically. There are certain critical minerals, of which copper is one, that you just absolutely need if you're going to have a manufacturing sector. And having a manufacturing sector is important, not just economically, because it tends to be a high capital, high productivity field with good paying jobs, but also for national security. You cannot defend yourselves if you do not have a robust manufacturing sector, and critical minerals like copper are essential to that. So will we be able to corner a market in copper? Absolutely not. But can we make more than we currently do? Yes.
So how long will that take? I mean, for example, when will these copper tariffs go into effect? Or is this just a stick rather than a carrot that you use to try and motivate the industry?
No, well, the president said we're going to do copper tariffs, and I think the president, and I think the president follows through on his promises. So I would expect them to happen. I don't have a date for that happening. Yeah. Well, I don't have a date for that happening. That process is underway.
All right. I want to ask also about the first point that you made, using tariffs not necessarily as a revenue raiser, but as leverage in discussions. I've watched Japan tariff U.S. automakers for decades now, and they refuse to back down. Are you going to be able to extract that kind of concession from such a stubborn economy?
Look, I think that the president is one of the best negotiators in history. I mean, he's spent decades negotiating deals across every field, from commercial real estate to international trade, and I have no doubt that he can negotiate successfully now too. But in order to negotiate successfully, other countries have to know that you're serious and that you're willing to do what it takes to get there, and that's what these letters show, that we are absolutely serious. So I hope that a country like Japan comes to its senses and does make the concessions they need, because it'll be better for them if they do.
Stephen, I do want to go back to your report, and I do appreciate the reports that have been coming out of the Council of Economic Advisors. I have been reading all of it. On the most recent report on the imported goods inflation, what do you say to the people that are looking at the impact of energy prices? Because if you subtract petroleum, you're not getting the same impact. In fact, you're seeing the price of goods rising in many categories that matter to American households, like electrical equipment and appliances.
Yeah, so you're right to flag that energy prices have come down and that we got to the lowest price at the pump since 2021, I think. And that's been a huge advantage to American consumers and a huge advantage to the American economy. It does drive the overall, some of the overall indices in the inflation data. But even if you take energy out and you look at core goods, as we do in our paper or at durables, you still see the same wedge. No matter how you slice the different goods data in the inflation data, there's a consistent roughly 50 to 60 basis point wedge between the price increases in domestically produced, in overall goods versus the price increases in imported goods alone. And when you annualize that 50 basis point wedge, obviously it comes to a bit more than a percentage point at an annualized rate. And so when you slice things like taking out energy or just looking at durables or whatever, you end up with different levels, but the wedge between overall goods and imported goods remains. So the conclusion continues to hold.
So I also want to ask about the central bank here. The president himself has been very, very vocal for the desire for lower rates. He has said just recently on Truth Social that 3 points is too high. And he's talking about the interest costs that are embedded with higher interest rates, which, of course, is a good point when you do have interest costs about to reach $1 trillion or more pretty soon. But at the same time, he has been very critical of the Fed. I want to read you this note from Neil Dutta over at Renaissance Macro. He's basically saying here that the pressure that the president is putting on the Fed is making it so that any future nominee has to be beholden to what the president is saying. What Neil Dutta said is Trump has created a litmus test for his Fed nominee. They have to agree to cut rates. If Trump picks someone close to his orbit, that person will look like a complete toady, and I'm quoting the research, and have a limited ability to persuade colleagues to a dovish position. At some point here, is the president's weighing in on central bank policy counterproductive for what should otherwise have been an independent central bank?
Thanks. So, look, I'm a huge fan of Neil, and I get along great, but I don't agree on this point. I don't think that at the end of the day anything matters but what the policy rate is. I think, sort of sitting around talking about, about optics and committee, sort of internal committee discussions doesn't really matter. What matters is what the policy rate is and what markets expect the policy rate to be. And if they expect the policy rate to be better for the economy, then we'll have better economic outcomes, and markets will welcome that. If the policy rate is set in a way that's not better for the economy, then we'll have worse economic outcomes, and markets will reflect that. I think the rest of it is just chatter. What matters is policy being set well, or is it being set poorly?
Stephen, can I ask about just the basics of raising revenue? What do you expect from tariff revenue, say, over the next 3 or 4 years, since that's what's left in this term? And what about golden visa revenue? I heard Howard Lutnick saying that you've got 75,000 applicants or queries. And at $5 million apiece, that would be like $375 billion, massive amounts of revenue. If you could, can you repeat that every year and bring in like at least a $250 billion in revenue every year from selling visas?
Thanks. So I expect the tariff revenue to be substantial. And in the research we put out about the deficit implications of the One Big Beautiful Bill and the rest of the administration's policies, tariff revenue played a substantial role in thinking about where the deficit would go in future years. We had about $3 trillion over a decade from it, which works out to obviously about $300 billion a year. And that's pretty close to where CBO ended up to when CBO got around to scoring it. So that's a number that I think is a reasonable baseline expectation. Given tariff rates are going a little bit higher now, the number might actually be a bit higher than that. So, I think it's such a fantastic thing to raise money from tariffs that are ultimately, the incidence of which is ultimately borne by the tariffed country, and use that money to finance lower marginal rates in American families and American firms to encourage more investment and more work here and encourage reshoring. I think that's just a fantastic common sense policy combination. With respect to the golden visas, I mean, look, I think that Howard has enormous demand for these things. He's created an amazing product. Howard and the president have created an amazing product. that has attracted enormous amounts of interest from foreigners abroad, and I think we're going to see that huge demand materialize. However, I think you're right to point out, I don't expect that demand to reproduce every single year. It's not going to replicate every single year. I think you'll see a big demand up front.
All right. Really interesting stuff, Stephen. Appreciate your time. White House Council of Economic Advisors Chairman Stephen Miran. Now we are back here with David Kostin, Goldman Sachs Chief U.S. Equity Strategist. I love the golden visas revenue idea, right? It's just so tantalizing to imagine getting $350 billion a year, but, you know, maybe that doesn't hold up. What do you think about the effects of one big, beautiful bill? Now that we have it, and Stephen was obviously a huge part of creating that legislation, now that we have that certainty, and now that investors can calculate, put it into their models, is it a good thing?
Well, I think the clarity, as you just referenced, is really the important thing for portfolio managers and for corporations. Corporate executives thinking about capital spending decisions, dividend policies, things like that, all are enhanced when they have some clarity on what the policy is likely to be. So in that regard, the fact that it was passed means we can look forward and see what are some of the fundamentals. And the idea the economy is decelerating but still growing is an important backdrop. And the idea that the Fed is likely to be cutting interest rates 3 times, the Goldman Sachs economics forecast, 3 times starting in September, twice next year. That is an environment where bond yields are likely to also be lower. 10-year Treasury yields probably around the 4.2%. And that supports our forecast of around 22 times multiple for the S&P 500. So that valuation, which is current today, we think forward earnings growth 7%. That lifts the S&P 500, in our view, to 6,600 by the end of this year, 6,900, 6,900 by middle of 2026, or next 12 months. That's the general backdrop. Again, the clarity on policy is important. And now investors have moved beyond sort of this year, really beyond the tariff discussions. The view is it'll be eventually resolved. And what's the general thrust of business?
You could make an argument that some of the market has already been looking beyond some of the current policies, trying to feel the impact of deregulation, lighter regulation. KBW Bank Index now up more than 12%. It's almost Super Bowl, aka bank earnings next week. And so that'll kick off. This earnings season will be really interesting to watch. Every single bank except one in the KBW Bank Index is up on the year. Have we seen the best it's going to get?
I think what important aspect to think about, we've had an incredible 25% rally in the last 90 days. A 25% rally in the S&P 500. It is a really, really narrow breadth market. It's really led by some of the largest companies in the market. That's fine. But the idea of the median stock, the typical company, is down 11%, 11% lower than its 52-week high. If you look at the mid-cap stocks, you look at the Russell 2000, these stocks are down basically 10%, or they're trading 10% lower than their on the 52-week high. As a consequence of that, the idea of some opportunities in these other sectors are where we are focusing our discussions with portfolio managers. The alternative within the financial sector, banks have had a terrific rally, as you just referenced, a lot of dividend increases once the CCAR results came out. And so what are some of the areas within the financial community that have lagged relative to our model? And the alternative asset managers are certainly one category that we focus on.
What do you think about the Fed path? As you pointed out, people are already looking to 2026, right? And at that point, President Trump is going to be able to put very likely a yes man, right? Someone who wants to cut rates dramatically in the chair. Do you expect that person to be able to push those cuts through? I mean, are you looking at 3 percentage points cut in 2026?
Well, what matters more for the stock market is real interest rates, real 10-year bond yields. So you think of nominal yields, we're looking at something in the vicinity of 4.25%, which is supportive of a valuation, as I indicated, around 22 times forward multiple. And that is the area that investors in the equity market are probably more focused on than specifically the path of the Fed policy. Now, our baseline forecast is you're going to get, because inflation is going to come lower, the economy is going to still grow, and the Fed has that capacity to be lowering rates. So that's the general path that we're anticipating, and that supports the market generally moving in a positive direction at this juncture.
So I'm going to ask our producers to pull up a chart, #BTV4400. This is a Bloomberg Intelligence analysis of the top 20 or so firms that have benefited most from tariffs and the top, or the bottom most impacted, like the worst performers, the ones that are most impacted by tariffs. The divergence is real. There has been a bounce back from the bottom of April. However, the best performers have been up almost 20%. The worst performers are still down almost 5%. How does Goldman think about this in baskets? What does well, and do the ones that have not performed well, do they continue to lag into next year?
Well, the idea of margins is at the core of investor discussions right now that we have, which is who's going to pay for those margins? Is that going to be the supplier? Is that going to be the corporation absorbing them? Is that going to be the consumer at the end of the day paying for that? And historically speaking, it's the consumer that ends up absorbing much of that cost. And now a lot of companies advanced their inventory at the beginning, so that makes the analysis a little bit more complicated. When you look at the share prices that you just showed in your graph, that could be complicated by the idea of this is how the share prices are performing. What about the fundamentals? And we're going to kick off next week on the 15th of July with all the bank earnings. And the next six weeks or so, we'll have much more clarity in the question of how is it that companies are dealing with these tariffs. And remember, the tariffs only partially were applied during the second quarter. So the second quarter still is uncertain. Now it's been pushed out in many cases really until maybe perhaps August 1st. So there's still a transition process here. But in terms of those stocks, there's certainly a lot of questions as to who's going to pay for the tariffs. And our view generally is the consumer. It's going to be ultimately passed on to the consumer.
You were here for an historic event, David. NVIDIA passed $4 trillion in market cap. We've fallen back a little bit below that, but we're there. And we've seen this company and this industry power the U.S. stock market higher for 3 years now in a row. How much more room is left for this gold rush to continue? I mean, where do you think we are if you were to compare AI opportunity to a baseball game? In what inning are we right now?
Well, let's think about that in baseball game. There's sort of phases of that. We think about phase 1, 2, 3, and 4. NVIDIA is absolutely in phase 1. We'll call that, the early innings that are necessary in order to build out the infrastructure. That's the leading edge of the infrastructure. Then you have the utility companies, you have other semiconductor companies, you have some of the hardware companies. That's sort of the second phase on the infrastructure. Now, where we are, I would say, is we're 2.5 years. November of 2022 is when ChatGPT was introduced. We're 2.5 years in. We'll say perhaps that whole transition process is maybe 5 years. So we're sort of halfway. First, to answer your question, maybe we're halfway through one scenario. And so you've gone from the leading edge, NVIDIA, you've had the infrastructure, now you have the applications. And most companies, when we talk to most companies and ask how is it that they're using AI, they're still looking for getting their data codified in a way that can allow the AI, generative AI, perhaps to make them more efficient. So that's the third phase. And the fourth phase is what's the long-term implications for corporates. And so another way of sort of summarizing this is the transmission mechanism for AI through the margin channel, better margins, more efficiency, or is it through the revenue channel? Is that companies can boost their output and get better sales? Mm-hmm. And there are different companies that are going to benefit or be different ways in which they can benefit. And so this is one of the things that I find most surprising is that only half the companies in the S&P 500 chose to discuss AI on their quarterly conference calls. Only half. The other half chose to, we're mute on the subject.
David, we got to leave it there. We're hitting a hard break. That is David Kostin of Goldman Sachs. Know you're on the road a lot, so appreciate you joining us here in studio. Stick with us. Markets still near session highs of the day. This is Bloomberg.
Let's get a check on the stock market right now using the move screen. I think this is the most dynamic way to look at an index, in this case the S&P. You can see we're off our session highs now, but still up on the day with the breadth about 3 to 2. 283 stocks rising, 218 are falling. NVIDIA adding the most points right now, almost 10 points with a 2% gain. It eclipsed a $4 trillion market cap, but has now under that a little bit. I'm going to take a look now at the sectors. You can see communication services. These are the hyperscalers as well as IT. These are the biggest gainers as we watch the Allen & Co. conference in Sun Valley, Idaho. Coming up, President Trump upending the global copper market. We'll take a look at that with John Wobensmith of Genco. President Donald Trump sending the copper market into turmoil. He announced a 50% tariff on copper imports, which immediately caused a record spike in New York futures and a drop in the global benchmark. This is the intraday trade today. It would have looked very differently yesterday. Companies across the world are racing to get copper aboard ships before the tariffs kick in. Joining us now is someone who owns a lot of those ships. John Wobensmith is the CEO of Genco. They own 42 dry bulk vessels around the world. And John, we were just talking, you have ships that bring back in one fell swoop 55,000 metric tons of copper from Chile. Are those in strong demand right now?
Copper in general is in strong demand. And yeah, there's about 1 million tons that are imported a year from Chile into the U.S. And I will say it was a little surprising to see a tariff put on copper. But when you start to think about it a little bit more, 25% of what the U.S. uses is actually produced here. And there is a brand new mine that is sponsored by Rio Tinto in Arizona that just got regulatory approval. So you have to wonder if there are some other pieces being moved around here.
That is interesting, but you look at also the amount that we import. You mentioned Chile. The other place that Chile exports a lot to is to China.
Yes.
How do these routes change? How does the equation for trade change if the U.S. is putting a 50% tariff on copper imports and China is not?
Yeah, so China is really interesting. They clearly, as you said, they import from China or from Chile. But they also have mining projects, particularly in the Congo, that are copper focused. So there are alternative sources for China. And it's one of the things China has been doing over the last 5 years in particular, and that is investing in other mining projects, particularly in West Africa, bauxite, iron ore, and then the copper that I mentioned in the Congo.
These tariffs, both the country tariffs and sectoral tariffs, have they been great for your business because of people pulling demand forward?
There's definitely been demand forward on soybeans, particularly out of Brazil. And we all know that the Chinese have gotten very close with Brazil, going both ways, but soybeans in particular. And so what we've seen is U.S. soybeans down 35% for this time of year. Now, we are not in peak season. Peak season really starts in September, and so that will tell the tale. But I do find it interesting, the last trade negotiations during the previous Trump administration, when they settled with China, they had a per ton, or tons of soybeans and ag products that needed to be moved out of the U.S. That didn't happen in this negotiation. As you know, it was more about rare earths than actual agriculture. So remains to be seen.
You tend to see things before the broader American public does, just the way that things are being brought into the country. Now, where else are you seeing that front loading? Where do you begin to get worried about inflation, if at all, with certain types of goods?
And where are things slowing down?
Yeah, so it's interesting. Not our business, but we obviously follow a lot within shipping. And if you look at the container rates, there was a lot of front loading into the U.S., China into the U.S. So those rates were, moved up quite a bit several months ago. The opposite is happening now. So container rates, China to the U.S. have actually dropped, but they've increased in Europe. Some of that has to do with the Red Sea hostilities again. But it's also because of a lot of the front loading that happened and the scarcity of tonnage available to go to Europe.
We were talking during the break about what's going on in the Red Sea, and there's a lot of very bad stuff happening there. Crews kidnapped and essentially terrorism, right? You're avoiding that by going around. So what does that add to a shipment in terms of cost? Obviously, it's worth it in terms of safety, but
yeah, look, it probably adds 10 days, and we build it into our freight model and our freight pricing. It's very upsetting what's happening now, because I think a lot of people felt that tensions were cooling down. Though We haven't put our ships through there since December of 23. That's when we made the decision not to go through there. But there have been 2 very recent attacks on dry bulk vessels. Fortunately, not ours. Again, we're not going through there. But it seems to be getting more lethal and more dangerous because we're actually now having crew members, unfortunately, being killed. And it's the pride needs to be solved. And
what's the answer to that, John? I mean, we have already launched a ton of attacks on the Houthis, right? Everybody got to read it in the Signal chat.
Yeah.
But it doesn't seem to have solved the problem.
It doesn't. I think we need more military assets actually there and patrolling. You know, we had that situation. We had a global force when there was piracy off the coast of Somalia. Indian, Chinese, U.S., I think we need more of a presence there. Because what the Houthis will tell you is you can go through, just don't call Israel. If you call Israel, then we're going to come after you.
Now, you mentioned you've been not going through the region since 2023, and that just goes to say there's been years of geopolitical conflict. When the broader American public is looking at the news, they're looking at kind of the worst of the worst happening. But realistically, there has been a lot of bad stuff happening for years to the point you've been making. So what is the risk geopolitically moving forward? And perhaps how could that create inflation spikes that are unwanted, right? It wasn't long ago that we were concerned about the closure of the Strait of Hormuz.
For sure. And I think, look, that probability has dropped significantly, which is good news. But that doesn't mean it's necessarily gone away. I mean, we find out, you know, tensions flare, you know, on a weekly basis. So I think that's much lower probability now, but you can't rule it out. The Red Sea situation is definitely adding to freight costs on the container ship side in particular, but also to some degree in our business.
John, it's really great to get such valuable intel from you, and really appreciate your time. John Wobensmith there is the CEO of Genco. Let's get a check right now on what's going on in these markets, because there is so much to talk about, right? In terms of single stock stories, you've got a flurry of deals, you've got potential deals, you've got share sales.
A lot going on under the surface. So yes, today the animal spirits are out to play. Even the 10-year has a little bit of a bid in it. We're going to talk about those deals that have been coming out this morning. We're going to bring in Bloomberg deals reporter Liana Baker, leads the team here in the United States. They've been breaking a lot of news. But talk to us first about perhaps what's going on with Merck. It's a really interesting move that they made with a patent cliff coming around the corner. What did you make of the price?
So there wasn't a huge premium here for a biotech, but it's a company that, for us at least, sort of came out of nowhere. It wasn't worth, this $10 billion valuation just a few months ago. So, but for Merck, this is a big deal. It's their biggest deal in years. They'd been sniffing around a lot of assets, so it's exciting to see them finally do something. But you mentioned the patent cliff with Keytruda, their top cancer drug, 2028. A lot of investors are watching that, and apparently this is just going to be a drop in the bucket. For Merck, it's only going to bring in $1 billion more of revenue. So while it's a step in the right direction, it's definitely not going to replace Keytruda, and we'll have to see more deal making to fill that gap.
And we mentioned this is a $10 billion deal for $1 billion in annual revenue for Verona.
Right. One of the stories we haven't talked about a lot today is the Meta investment in EssilorLuxottica. Of course, they already have been using those brands.
Ray-Bans.
What's the story? Ray-Bans, Oakleys?
So not a takeover per se, but definitely interesting to see Meta investing up to more than $3 billion in this company. We did see Google a few months ago invest in Warby Parker, a smaller investment. So all eyes are on this space. It's unclear, the exact terms of this, but it had been in the works, I think, a long time. There have been reports back in 2024 that Meta was looking at this. We're interested in Meta doing all these deals. The Scale deal a few weeks ago was also big, so they really seem focused on the future, and they're trying to invest in different companies to sort of fill out, what's next for them. And Mark Zuckerberg's in Sun Valley, apparently.
Maybe more deals where that came from. Also in Sun Valley, Ed Ludlow breaking a scoop overnight with our team. SpaceX inking a new valuation with a planned offering of insider shares being sold, $400 billion. What do you make
I
of
think
that?
it's even more, and it's crazy and hard for any deals person or investor to understand these valuations. I know there's a lot of attention on SpaceX, the Starlink satellites. I'm interested to see if they raise a primary round. That was mentioned in the report. That would be new money coming in. But in terms of a SpaceX IPO, what would that be worth? When would that happen? So our team is trying to figure out these sort of longer term.
And do they need it?
Right, with so much insider money, but at some point, some of these valuations, you have to ask: is it sustainable? I know it's Elon Musk, SpaceX is sending these rockets up, sometimes successfully.
We've been asking that question about Tesla for 15 years, Leanna. 15 years of that's an insane valuation.
Right, but just these eye-popping numbers are definitely keeping us busy and, attracting a lot of eyeballs.
Listen, people don't sell. If you have a SpaceX share today and you're a private wealth investor, people hold on to it very, very closely. Now, if it's in public markets, Liana's point about a $400 billion valuation, could it hold up when you can get in and out as quickly? I think that there's an interesting
Can I just remind you that Tesla's worth $1 trillion? So the answer to your question, could it hold up, is yes.
Good.
100% yes. Right? Because you see that investors are willing to pay almost anything for exposure to Elon Musk, and this is just another way.
It's all in the private markets, though, so it's hard to see, this actually trading hands. I'm sure it's a great report, but we don't. It's very different than like a Merck acquisition where we could read, exactly what people are paying for that.
Great to have you on set with us, Leanna. Thanks very much. Leanna Baker runs our deals team. Coming up, Goldman Sachs has a new plan to help stop private equity firms from stealing its talent. They're going to make you promise, if you work there, that you haven't got a job lined up somewhere else. We're bringing the details next. This is Open Interest.
And I want to now bring you some breaking news. Linda Yaccarino, so she is stepping down as the CEO of X. Of course, this has been 2 years that she's been running the company. When she came in, there was a lot of questions on how she would navigate a relationship with the CEO who's known for being very, very involved. And of course, there have been a lot of changes under her tenure. We're going to bring you more in just a little bit as we know it. But of course, a big deal for X. Of course, not publicly traded, but very closely tied to the capital markets of late, as this company has been making a lot of moves with bringing on new investors. Now, it's time now for the Wall Street Beat. This is our top story of the day. Goldman Sachs plans to ask junior bankers to swear their loyalty in a bid to thwart poaching by private equity firms. Joining us now for more, broke this story, Bloomberg reporter Todd Gillespie. So we know that private equity firms have been going earlier and earlier to talent. We've heard as early as sophomore year of college. Goldman's used to this, isn't it? And I think you and I have both heard Goldman bankers say it's been a while since we've heard a private equity firm taking some of our talent. So what happened?
Yeah, well, I mean, what we know is that Goldman is now planning for their new analyst class this year to start implementing a rule where now every 3 months they have to, for conflict of interest rules, of course, tell Goldman whether they have already accepted a job offer from elsewhere, whether they've lined up a new opportunity outside the firm, which could potentially present some problems, some headaches. Maybe they're going to be working on a deal for a private equity company that they're about to join, but their bosses don't know that yet. Those are the kinds of headaches that these MDs want to avoid. But obviously, they also just want to make sure that they're keeping their best talent. So at the end of the day, this is also a, let's just make sure that you're in your seat for a while.
Why is it such a big deal? I mean, isn't the idea that you go to one of these analyst programs for a couple of years and then you're free to do something else? Does Goldman Sachs really want to hold these people there and develop them?
Right, David Solomon is so excited about his alumni network elsewhere.
David Solomon is very excited about his alumni network. David Solomon does boast of these boomerang hires where people go away and make big bucks in private equity, come back as partners to Goldman Sachs. He likes boasting about that in earnings calls. We all know that. But fundamentally, Matt, they also want the best bankers at Goldman to stay at Goldman, and they want to know that the people they're investing in are going to be there for the long haul, and that they're going to provide the kinds of intelligence, the kinds of networks that Goldman want over the years.
But surely, Todd, there are other ways to do that. Rather than having somebody swear an oath of allegiance right? Why don't you just say, here's a pay package that's weighted heavily to later down the road?
Yeah, there are certainly ways of doing that, I'm sure. I mean, I think a lot of, I think a lot of the banks have tried these sorts of moves over the years. There's also a limit to how many people they can promote. Obviously, each year, a lot of these young, up-and-coming talent, they want to get big bucks as fast as they possibly can, and they know that private equity is willing to pay bigger pay packets.
So, want to bring up the meme stock accounts here, because these are the ones that have pushed kind of justice for the junior bankers for the last couple of years. High Yield Harry says these big bad banks are genuinely too scared to talk to sponsors about pushing back recruiting, so they take it out on the 23-year-olds. They have been working 80+ hours a week. Now, how do you respond to that? Why don't they just, it's true, right? Didn't Apollo just come out with a note very recently about how they were going to stop poaching for the banks and stop pissing them off?
And I mean, that is one thing, but I don't think it's actually just about pissing them off, to be fair. I did speak to one banker a little while ago who told me, just a couple of months ago actually, and they were saying that a lot of their own private equity clients, their sponsor clients, had told the banks, look, we know we've pissed you off for a few years now. We're gonna ease off, partly because the talent we're getting from you actually isn't as good as we want it to be. Actually, it would do us better. It would serve us better if you train them up for just a little bit longer, maybe 3, 4, 5 years before we poach them, just so that they've learned all the skills that they need. Because a lot of the young folk that they were getting into these PE firms just weren't at the level that they thought they were at, because they were hiring earlier and earlier and earlier, and these people didn't have the experience, hadn't proven themselves and got those skills that they really needed at PE firms.
Todd, awesome story. Instantly became the most read story on the Bloomberg terminal and has been there ever since in the #1 slot. Of course, everybody wants to read about this. Todd Gillespie covers Goldman Sachs and the banks for us. I want to get back to that breaking news now that the CEO of Twitter, now known as X, Linda Yaccarino, will be stepping down from the company after just 2 years. She said it in a tweet, doesn't give a reason. We bring in Bloomberg's Max Chafkin, who covers all things X and Elon Musk for us. Why do you think she's leaving?
Well, if you've been following the news lately, there have been quite a few reasons, I think, that have pushed Linda Yaccarino away. I should say, first of all, 2 years is a long time in Elon Musk's orbit, especially in the role she was in, kind of serving as a buffer between Elon Musk and the world of advertising. That's going to be a very difficult situation for anybody. I think most people did not expect her to last anywhere near this long. So in that sense, it's a really impressive run. And I think in certain ways, she's done a lot, right? Like they managed to, it was a very chaotic couple of years or a couple of months at the beginning of her tenure at Twitter, kind of righted the ship. The problem is you have Elon Musk sort of relentlessly, changing things up in ways that I think have been super unhelpful. Of course, and you'll remember this well, bringing back all these far-right influencers, that's the kind of thing that advertisers don't like. And just in the last couple of days, we've seen this new version of Grok that is sort of just spouting anti-Semitic, cliches and praising Hitler and so on. And if there's one thing big advertisers don't like, it is having their ads adjacent to that kind of content. So that, I think, is making her job untenable. The other thing I'll say is Elon Musk just merged X, the company formerly known as Twitter, with XAI, his AI initiative, which owns Grok. And it was always a little bit unclear what her job was going to be. It seems like this is Elon Musk's company now, not sure what Linda Yaccarino was going to do.
I've been scanning his own X account, and I don't believe he's weighed in on this yet. And that was going to be my question. With the merger of X and XAI, listen, just to run X, the handful of people who could do it wasn't that large, was it? Not with Elon Musk, if you will. Now,
well, he's running X, right?
Right.
Regardless of who he puts in place as CEO.
She had a mark.
Yeah, I mean, the thing that she was able to do, and you saw it, they brought in a handful of influencers, most prominently probably Tucker Carlson, who has developed a pretty substantial following on X, since leaving Fox News. She was sort of trying to build kind of a right-wing media platform, and I think that actually made a lot of sense. You saw that kind of reach its peak around the election. You could really feel like the energy of conservatives going there, but that really depended on Elon Musk having a, good relationship relationship with the man in the White House, and that, of course, has changed as well. So again, it's a lot of things that I think makes the job of selling advertising hard. There's also a way in which Musk himself has undercut that business, not only by, putting all this edgy content on X, but by moving towards AI and sort of signaling that the point of this company is not to create content that you're going to sell ads against, but it's to train large language models and eventually an AI, and that is a different business altogether.
Really interesting moment, of course, and I know we're going to have more throughout the day from not Elon Musk, but also from Sam Altman's conversations at Sun Valley. What a day! Max Chafkin, thank you so very much for joining us. For more coverage on Elon Musk, don't miss the weekly Elon Inc. podcast from Bloomberg Business Week. This was one I'm going to want to listen to very, very closely. We're going to switch gears. We're going to talk about the fund management industry. Active managers, they're being forced to adopt hedge fund strategies in order to stay competitive, according to French asset manager Archaea. Joining us now for more, Bloomberg senior equities strategist Michael Masika. Hedge funds were out of favor for a while here. Now they're starting to roar back, even if they're trailing broader indices. What here is the big pitch, especially as we know the biggest of big hedge funds are paying top dollar for top talent. Can we now see an asset management industry that's doing copycat techniques with a little bit of quant genius in it?
Hi. Yes, I see the point. The thing is here, access to hedge funds is very difficult. What you had is like a lot of retail investors can't really access them. They're like a very, very high amount of money that you need to invest in them. The liquidity is not good. So, they turn to ETF, they turn to passive asset management. So here is the thing. With regulation evolving a little bit, now you have access to funds that have daily liquidity that can protect your portfolios with what they call an overlay, which are like a bespoke derivatives. And that's new in the industry, and I think that's what's interesting here. That's the story that's interesting. It's like giving access to hedge fund style without being a hedge fund.
The thing about it, is this an acknowledgement here that this market is being driven in a large part, not just by retail investors, fine, that's a marginal buyer here, but by quantitative investment strategies? Ultimately, you're not reading the human on the other side of the room, you're reading the machine.
Yes, but what's happening is like people tend just to buy the market as it is and just like ride the gains. The problem is if you're getting into a fund or you're getting into an ETF at the wrong time, what's going on? You're going to need to wait a lot of time before you actually recoup your losses. I mean, obviously, we had a very quick V-shaped recovery recently, but that's unusual. In theory, when you have like a crisis, it can take years before you get your money back. So if you invest in strategies that are, protect your portfolios and that kind of limit the downside, then you're kind of like more confident in your investments. And you know that you can invest pretty much anytime you want.
Michael, we thank you so very much. That is Bloomberg's Michael Masika. And Matt, it's really interesting. A top story on the terminal now is about all the hedge funds making money off of merger wagers, because in the Trump administration, they're starting to pan out, Discover, Capital One, U.S. Steel, Juniper, Hess, Calanova, and a lot of money is being made in that strategy in hedge funds too right now.
Yeah, I'm still blown away by the U.S. Steel deal, but it's true. We're finally getting these deals done, and this is what the market was betting on after the November 5th election, that we would see deregulation and that, some of these combinations, purchases would be finished. Now merger arbs are cashing in.
Patience has paid. Let's go check out these markets. It's a good day.
Yeah, it is a good day if you're long these markets. We have the S&P right now gaining only about 0.2%, so well off of its highs from the early trade. 62.36, the level. I think 62.79 is the closing high from Thursday. The Nasdaq up 0.25%. Nvidia right now gaining almost 2%. It did cross that threshold, worth more than $4 trillion. Coming tomorrow, Wilbur Ross, former Commerce Secretary, joins us, as well as Julian Emanuel.